Recording now in progress. Okay, guys, it is July 21st, 2024. We are doing the July AMA. We have a zillion good questions from you all from the Patreon, but does anybody want to start it off? Or I do know that one of the big things we wanted to talk about was IWM. So any first questions, or should I just start there? Okay, let's pull it up. You know what? This Zoom thing is still getting in my way. I can't type the ticker. 1 second. Okay, here we go. So IWM is up. There we go. So for context, let's take the big picture here. Let's actually take the really big picture just because it's kind of funny. So IWM has not gone anywhere for a really, 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 really long time. Like this is effectively 2021, the beginning of 2021. We are now in the middle of 2024. So for 3.5 years, IWM has actually been down like 10% or more, while the rest of the market, of course, is, Qs are at all-time highs and everything else. So a lot of people have gotten into the world of small caps and medium caps are kind of dead. Long live mega tech. Mega tech is everything, yada, yada, yada. And you start to believe these things at the tail end of cycles where even I'm like, oh man, is like tech just going to go on forever? And maybe it will, maybe it won't, but it does speak to the sentiment involved with everything. And so what ended up happening is on this day here, which was July 11th, there was a CPI reading. I think it came in, I think it was what, like 0.2%, less than expectations. Don't quote me on that, but essentially, this started just a change in views. I mean, I think a lot of times like stuff doesn't need to make that much sense, because you could argue like, okay, this is just one data point. Who really cares? Why all of a sudden do people care so much about this one data point, which isn't even that big of a difference versus expectations? And which I would just say, who knows? But let's look at this reaction. So this was on 7/11. 2024. So let me just jump to that. Okay. Uh-oh. It wouldn't be a normal video if I didn't at least fumble like 30 times on something. Okay, so 7/11/24. So this is when the CPI came out and IWM explodes, and then it really just keeps on going. And we close kind of top tick strong for what's almost like, it's looking like almost a 4% up move, which is, of course, very, very massive. Now we're going to quickly compare that to the Qs. So one thing alone that's interesting is the Qs went up with the rest of the market at 8:30. Then it started to pair the gains, and then we're trading flat. And I think like when this starts to have such a divergence with IWM on essentially a data point, like a piece of news, even roles like this are extremely, extremely interesting. And so the other thing that's interesting, if I'm not mistaken, this also happened, was this the day when Tesla cracked as well? Yeah, this was the big Tesla crack, which I'll probably cover in the top ops video rather than now. But long story short, like IWM being up multiple percent and the Qs then pairing their gains and rolling over, clearly there's some type of rotation going on, right? Generally, the market tends to trade in one direction. So what ended up happening is, big picture, this IWM closed very, very strong. The market, the Qs closed very, very weak. So that is a big sector rotation. And the other thing I'd like to point out is the volume on this was like pretty enormous. I wouldn't say it's like the biggest thing I've ever seen, but it was pretty damn good versus normal. And this is just closing strong towards the top of this range. So I do think when you get some of those moves on news, like it's not that crazy to buy weekly calls or something like this and notice that sector rotation. This isn't really hindsight. Like I do know people that did this. I've been trying generally not to trade too much at all, so I didn't do any of this. But the other thing too is a lot of these narratives then tend to become a feedback loop, where I remember the day that this happened, like everybody was texting me this meme where it was like, it was like IWM getting this medal, and like it was still just like, oh, it had one good day, but every other day, you know, for the last like 5 years, it sucked. And what that says though is it's very possible that a lot of people doing some of these pairs trades are kind of offsides, and this can gain momentum. And so sure enough, that's kind of what we did the next couple days. And so one thing to keep in mind is like IWM ends up going up over 10% in a week. That's like a pretty damn big move for an index. And then what ends up happening is on this day, we start to, really go, and then we close weak. So a couple things, like in general, I tend to like selling options premium when vol really blows out like this. So especially this day on the 17th, I wasn't so sure when this move would stop, just because sometimes this stuff can have legs. The other thing I wanted to be careful of is if we go big picture again, sorry, let me go even further out. Like, yes, this move is pretty big as far as 1 week, but I also want to keep in mind that this index has not gone anywhere. So I guess like what I'm saying here is initially I was bullish, but then I was short-term bearish. But I also want to be cautious big picture, because if this goes to like 240 or higher, then we're really talking just all-time highs breakout in an index that has lagged for many, many, many years, right? If I take this chart of the Qs have just been absolutely on fire, right? Like we were essentially 25% above all-time highs. So you don't want to be so myopic that you're thinking, oh my God, this is the biggest IWM move ever. Like I think some people were just totally salivating over this move, when I definitely was interested, but I was somewhat cautious. And because I wanted to be careful with that timing, like I was happy to sell weekly calls for this week, but I didn't want to say, for example, sell monthly calls just in case this does really break out and it ends up like, okay, this rotation's legit. So a couple things now, right? So a couple things regarding the daily chart is this first day was a big move. But then I'm also factoring in the fact that this second day was not so big. Yes, we gapped up, but we didn't close that strong. We closed even on the weaker end of the range, then we gap up and we go again. But then this day, we really, really, really start to accelerate. And when we get an acceleration like this, like, again, this is just an index. It's not normal for something to move. I think this is like a 3% move or so. Not normal, especially when the rest of the market is kind of rotating out. Very, very big move. The volume was very, very big that day. So that's when I'll start to look how expensive the calls are. I didn't want to do any short yet. This is front side to me. So now let's jump to this July 17th and the 19th, or oops, sorry, the 17th and the 18th. And the other thing I would say is just keep in mind this image, right? Essentially, we're up, 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 up. So 1 day, 2 day, 3 day, 4 days. And, this was kind of that high. So remember that image and how far we went. And now we're going to just dive in a little bit. Okay, I said 17th and 18th. I really wish there was kind of like an easier way to just click this stuff rather than me fumble every time in front of everyone. Get a lot of performance anxiety during this. It's all for perpetuity for everyone to watch. Okay. Let's see. So this was effectively the high day. And so the other thing that on Twitter, Skyquake, aka my friend James Chen, aka this really massive Australian trader who's extremely talented. One thing he pointed out on Twitter too is a lot of the push and euphoria started to really happen off the open with some very aggressive buying. And so this is on the day that was the top. And okay, let me zoom in a little bit more. And so what we get here is we get a push off the open, and this is not a nothing move, right? And an index moves up 1%. I don't think there's anything wrong with shorting those break of prior bar lows. I don't think there's anything wrong getting stopped out. Like if you short there and you get stopped out, like a lot of people think like, oh, that's so hindsight to only just short this one. But the reality is that like if you short this one, that's fine. I think that's a totally fine trade. Like I'm definitely open to shorting this. But what people miss is like this is a potentially good trade. If it then makes the same symmetric leg, this is even better. And so one thing I'm going to talk about in Magnum Opus is kind of just the power of symmetry. And so what I want to point out here is like this did a $2 leg and it kind of retraced a little bit. And I consider this the second leg. So this is almost like leg one, pull back. This is leg two. So symmetry isn't some perfect thing, right? This easily could go to 228, 229, 230. It can go anywhere. But if I need just a simple heuristic, in general, my best bet is that this is going to go a symmetric amount. It's just a rule of thumb. So what does that mean for me? So one, when the vol is just absolutely exploding and we're doing the second leg, I'm definitely eager to just sell calls while the vol is exploding because if this goes way higher, I want this anyways, and vol is insanely jacked up. I think the 227s were probably, as far as the weeklies, were probably going for like $3 or something, which is pretty damn enormous after a move like that. Then the other thing is, again, short of breaking the prior bar lows, just right side of the V, like I think this is an amazing trade, right? Because now it's the second leg. Essentially, the index has gone a couple percent in just 30 minutes. And you can catch a really nice leg where prior bar highs takes you all the way to 224, I believe. Like that's an awesome trade. So I think that alone is pretty interesting and a pretty decent opportunity. So then what's worth noting is we close pretty weak. And so one thing I'll point out as far as the dailies, the daily chart goes, is I think that then makes the low of this day around, call it like 221.70-ish. I think that's where we're talking. So given how aggressive and explosive this is, like this then pulling all the way back makes me think a top might be in. And by the way, the other thing I would want to point out is, let's say this pattern, this pulls back a little bit, then we make a third leg. Like that's the type of thing where like generally I love 3 legs. Like even Tesla did this in one of its moves earlier this month. I love when a third leg happens, and I'll get way more aggressive. So I might risk 1,000 here. I might risk 4,000 there, and I might be willing to risk 10,000 on that third leg if it were to have happened. So that's important to keep in mind. And so now with that context, let's go to this day or the next day. Okay. So what ends up happening is we end up opening a little bit below the prior bar, the prior day lows. So technically for me, that is a break of trend. But now keep in mind, you know what? I kind of want to, I'm gonna have to retype this. It's okay. Let me go back. So one of the topics that I think I really try to impress on people is really the geometry of some of these chart patterns. So let's kind of like dissect this a little bit. The lows of this day were kind of the 221.66. We technically opened below prior bar lows, which technically means for me and my system, it can be different for you and whatever you want. But for me, that means that this is the turn and this is backside. So let's say I short at 221.50. Generally, my stop is prior day highs. So what that means is I'm risking $5, right? $5 on a pattern like this is a fair amount of risk, right? Like $5 kind of brings us all the way back to 221, like 16 or so, or even 15, which is pretty damn big. So my point is like, if I'm risking all the way up to these highs, that's a hell of a lot of risk. I might not want that much size on this. Like I don't necessarily love that so much. But the interesting thing though, is what happens when this off the open starts to push higher against the prior day highs, right? What happens is if this goes to 223.50, I'm risking 3 points. When this goes to 225, my risk is now just roughly $1.60, $1.50 or whatever. And so guess what? What happens to my reward? If my target, like let's just make up and say, my target is 215 or something. If I short at 221, my reward is 6 points. But if I short at 225, my reward is 10. So not only is my risk going down, but my reward is going way up. as long as I think the probabilities don't change, that means that as this pushes into this bar, and like, don't get me wrong, the probabilities are changing, but I would argue that when this turns backside and after such a weak close like this, when this pushes up towards 225, this is actually exactly what I want it to do because my risk is getting smaller, my reward's getting bigger. And from experience, the odds are still very good that this is going to put in a top after a move like that. So I might want very, very little. And I had no shares, but then once this pushes like that, my confidence that, oh my God, like this could be that lower high. And look, this is exactly what ended up happening. We did end up forming prior bar highs that have still held, right? So whatever happens on Monday, aka tomorrow, like our risk is getting smaller and smaller because these bars are kind of trailing, and we caught an amazing, amazing move potentially. And so that's why I always talk about like really understanding the geometry of these patterns and how it changes. Does that kind of make sense to everyone, or like does anyone want me to explain that in a different way? Because I think this concept is so important and something like I'm going to try and do a lot of stuff on in the future.
Hey, Lance, I left a comment or a question for you in the chat.
Okay, let me see. Yeah, so that's one thing that if I did actually proper video production I'd love to like really make a graphic on this. So yeah, if we were to take and we can kind of, let's estimate some stuff, right? Let's say my risk here, and I'm just going to use round numbers to try and make this super easy, right? So let's say that this is $5 of risk and maybe $5 of reward, and maybe there's a 70% chance this works, or a 60% chance this works. Okay, like that makes it still a okay trade, nothing that exceptional. But I would argue that when this starts to pull in close to those highs, especially when it does it in a euphoric manner, right? Because it also matters how it gets there. And when we dissect this bar in more detail, it's getting there in the same very euphoric, aggressive manner that happened the prior day off the open. Just that really just kind of like aggressive buying, sharp, high slope. And so what ends up happening is when it moves like that, I'd argue that the probability of this pattern holding is still pretty good. So maybe the win rate might go from 60% down to 40% or something. I'm kind of just making these up and estimating. The win rate might go from 60 to 40, but the difference is my risk is changing so much. It's only $1.50 now. And the best part is the reward is now almost $10. So yes, exactly what you said, is that yes, I do argue that EV is going up, especially, but again, the details matter. When the intraday does it super sharp and fast, like the way this intraday panned out is exactly how I would have wanted it to happen. And so I would say this is kind of like a perfect case study for how I want to see that lower high being made. So let me jump to July 18th so I can show you on the intraday, because those intraday nuances do matter. And that's why it's hard to get just me to tell like some flat percent, because obviously this stuff does kind of matter. But watch. So what happened off the open is we almost get the same pattern we saw the prior day, right? Like we get that pattern where we make an opening drive, we fail, we kind of reclaim, and we make that second leg. So this is the exact same intraday pattern as the prior day. And so shorting this turn again, I'd argue is really, really good, even from an intraday trade, but it's also really, really good from a daily swing. And, I had this conversation with Ozzy where Ozzy felt that this move was steady, but keep in mind, guys, this is just an index. Like an index went up 2% in 30 minutes in this like very aggressive buying that it kind of did the same as the prior day. Like that's not really typical. On most days, an index just sits off the open. Like let me see if I can, let me go to the 15 days. Like let's look. Okay. And just your normal day. I have no idea what day this is really, but like, okay, what happens on this day? Like essentially, yeah, we kind of open around here and then we barely move 50 cents. Like I'd say this is like a normal day where we don't have much going on. If we look at this right here off the open, like it's still just staying like, yeah, it's moving, but it's nothing like what we saw on those prior days. Uh-oh. So, oh, because it's earlier. Hold on a sec. And let me get the chat real quick. Explaining probability going from 60 to 40% makes sense. Yeah, and so keep in mind, like it's kind of, we'll never know some of these exact probabilities. A lot of it just comes from experience and kind of like that's the hard part about trading is you never know the full probability spectrum. Like I will never know the probability of this pulling back. But like through experience, we can roughly estimate it. And a lot of that comes from just like taking a lot of just Evernotes and databases and everything else. So Drew was saying, yeah, prior day it closed weak. So you're seeing the same pattern. Yes, exactly. So, and later this week, I'm giving a Trader Lion conference talk on the limitations of backtesting. And so to me, all these nuances matter. So how do you backtest this pattern where it's like, oh, wait, first of all, we've got aggressive buying off the open the prior days. We've got a day that closed really, really weak on very, very high volume. Then we've got that same pattern off the open after it's made a 10% move. Like you're probably not going to find too many data points, if any, with all those nuances. So between the weak close, us gapping down and then being just really pushed off the open, like, keep in mind, like we start right here and to go from 221 to 225 in 30 minutes, that is a really aggressive move. Like what really changed then other than just this was aggressively bought? So all those nuances make me think, and I know people will say hindsight, but for what it's worth, like, whenever I took the snapshot for that tweet, I think like IWM was still probably at 222 when I did the tweet. But keep in mind, if it's at 222 when I do the tweet, when I start preparing that stuff, it's like still up here even, because it takes me time to like draft these and I tinker on like with paint and crap. And so far this pattern's held really, really well. So I think, let me make sure I got all these questions from the Patreon itself, because there were a lot of these. So yeah, Ozzy wanted a general dissection of the backside. So yeah, so then Matt was asking, can you share more detail on the trade? For the entry, were you waiting for a 2-minute bar fail? Are you definitely holding versus that high? Is there any scenario you would cover? And so this is where, when we're talking about edge erosion, before I started recording this, there's just so many ways to structure this trade. So you can do this as a total swing trade where, okay, technically we broke prior bar lows, we push into these highs. So you can be shorting, 224 to 225 against this high and just holding it purely on the daily, which has huge liquidity, right? Like no one's ever going to ruin the liquidity on a daily swing trade like that. You can be playing it just purely based on the intraday, right? So the same way with these intradays, we talked about how the one day you could have done this short and caught that 2-minute bar leg. There's nothing wrong with, oh, I'm a day early, I think now. I think I need to be here. Yep. There's nothing wrong with going for this short and covering there as well. Like, I know it doesn't look like much, but as far as the easiest, highest probability leg, it probably is shorting right here and covering there. I don't think that's some super amazing, incredible trade, but it's also just not that complicated. So I think there's ways to do that. And so then the other thing too is I didn't think that this would melt as much as it did. If you think it's going to melt, the beauty about these indices now is you have all the 0 DTE options on this. So if you thought this was going to kind of really reverse like it did, which again, I personally did not have that view. I had the view that it wasn't going to go higher or break those highs. But if you went into some of the options and you had a different view than me, you could have epic killed this move. There were options that probably went up 50 to 100x between, 223 plus and down there. So the other way, of course, you can do it, and that's what I ended up doing, is I just, like right now, especially when I'm not trying to actively trade, I just sold 0 DTE calls and I sold weekly calls. And again, the premium, when this was doing this push, were super, super high. I think I sold 225s for like $1. So essentially when I sell 225s for $1 or whatever, that essentially is me betting that this pattern holds. And it gives me a full dollar cushion, which is pretty good. So there's a lot of ways to kind of structure these things. And so one question is, in how might I consider pyramiding these versus adding risk versus just keeping the core. And I think that's also where it depends for the individual trader. And keep in mind, like there will be traders out there where they're just trying to work into a really big position. So what some traders might do is it's possible you short a good chunk here and you don't even want to cover that, right? If you're just trying to work into a big position and the higher it goes, the better, you might short 10,000 shares here and you might short 30,000 there and just hold the whole core. Sorry about that motorcycle outside. So there's many, many ways to structure these things. And that's kind of where it's like, when the people are like, oh my God, all the edge is going to be gone. It's like, well, no, there's many different ways to do this as a swing trader and intraday. You can do it from options. You can do it from equity. So a lot of that depends your tolerances. Some people want to have zero drawdown and take, zero big hits, and they're just going to catch like the little legs, and that's fine. So Drew's saying 223.5 looked like the best point to short flat bottom with lower highs, 223. Yeah, and so the other thing, and I highlighted this on Twitter, is there's also where you can just short this head and shoulder like pattern right here. And that's like also a great entry where we've got this move, this kind of second leg. It makes the lower high, it makes the lower high, then boom, we break. This is like the break of 223.50 to me in my head, like that's pretty much game on. Once that breaks, it's like, okay, like the daily's backside, the intraday is probably now backside. We're below the moving average. So I really, really like this even as an entry. So again, for just this one little play, we've probably discussed 8 different ways to trade it. And that's why a lot of this is still just like, you need to make it your own. And there's just a lot of no right answer. It's up to you and everything else. So let me see. And so I guess specifically, like, am I holding versus that high, or is there any scenario where I would cover? So in general, like, especially for stuff like this, I don't want to make this little leg. I want to do this for the most part. I was interested in this as like a daily swing. So yeah, anything I shorted on this day, I'm generally holding to the prior day highs. Yeah, but again, that's just me. So what might change my mind? So some things that might change my mind is what if this starts to consolidate out up here? Like if we make this leg, we consolidate all day, then we break 225 after like a 4-hour consolidation, just because that intraday chart is so powerful, it's very possible that I might want to just take most of my covers or cover the whole thing. I don't know. It depends how I feel. But so yeah, like I'm trying to listen to both charts because the best trades are going to work the best when they both align. So yeah, if this were to be consolidating super aggressively against 225 all day, I would not feel good if we then broke to highs. I probably might just get out, especially if like it then entailed overnight risk, but IWM, you can pretty much trade near 24/7. Let me see if I covered all of these. And so Neil had asked the question, when something that's really in play, so like yada, 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 or even IWM, but they don't set up so clean intraday for any sort of bouncy ball breakouts or capitulatory turns, how do you know when to go for these versus when to stay away? So I would say, if I don't get a setup, like if there's not a setup in my playbook, or if the intraday doesn't set up, like what if IWM had kind of just like, I don't know, like I would say this was aggressive, even though Ozzy, thought it was steady. If this went up at like this slope, just a total +1, steady, 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 I probably want 0 shares. So in the thought of like, what if it doesn't set up for me? Like if it's not in my playbook, I'm just going to not trade it. I really like, part of being a really good trader is accepting that like stuff can look really good or stuff can have a lot of potential, then it might just not set up for your playbook. It's the same thing where it's like, if you get pocket aces, that hand has a lot of potential, but then if the flop turns 6, 7, 8 of hearts, all of a sudden your pocket aces, which had a lot of potential, might now totally suck, and you just need to accept that you need to fold. So if something isn't doing, like, I think people don't realize this, but part of the reason why my win rate is so high is because if I'm generally not trading if it doesn't set up for exactly what I want it to do. Like, yes, I trade less and less now, but that's also me just always being selective. Like, so often I would get traders ask me, there would be some stock down 15% or 25% or 30%. And other traders in the firm would be like, oh, like how did you not get hurt in that? And it's like, because even though it's down a lot, I still need the intraday to set up in very, very specific manners for me to want to play it. Like, as you guys are starting to realize, so much of my trading needs to be just so nuanced to get the edge in my favor. So Sean H asked, you mentioned that the intraday nuances matter when shorting against prior day high. In what intraday scenarios are you not hitting a short? So in what intraday scenarios am I not hitting a short? So things that I wouldn't have liked is if this, say, off the open went down, then it kind of reclaimed and started to be steady, steady, strong. I definitely wouldn't want that. That wouldn't have been as appealing to me. If this was just like, rather than an aggressive move off the open, if this was very, very steady, then we consolidated up by highs, then we broke out. I don't want any short. So like the intraday does matter. I will say, like, if we got up to 225 and it was kind of a mediocre intraday, I still might want just a little bit of size, but I would argue that what made this trade so good was that it did the same kind of two-legged pattern off the open. And again, guys, like, you need to keep in mind, even though for the last week, big moves in IWM seem, were made normal, like this to make a 2% move off the open is not normal. For this to go from 225 to 217 and have like a 4% range, 3-4% range, that's definitely not normal. Especially think about how many days we are after CPI, right? Like, in theory, that data point is out. Everybody should be able to process that. Yeah, that was kind of a ridiculously long amount of time on IWM. Any questions still based on that? Because it is pretty important overall. And the other cool thing about IWM is, like, obviously there's pretty much near infinity liquidity to do options, equity, all sorts of stuff. If you short 20,000 IWM, nobody is really going to notice. Yep. Any questions on that? Okay. So let's move on to some of these other ones. So there was a question from Jake. How did you go about scaling up? Was it increasing risk 10% every month on A and B tier setups with the exponential bet sizing, or was there another way or system? During the months of 2020 and 2021, were you risking A tier more times or even higher tiers of risk, knowing it was a great market? Would you have different methods of systems for the two answers you give based on what you know now versus then? So this is a good question. So at the end of the day, like, why is there not some universal answer on how people should increase their risk? There isn't a universal answer, just because all of us are different with our personalities. Some of us are more risk adverse. Some of us, if we get into a hole, we crumble. Some of us, if we get into a hole or take a big loss, like, we end up more motivated and more desensitized to risk, and it actually kind of helps us long term. My general rule of thumb, though, is you want to increase your risk prudently enough so that if things don't work out, it does not mess up your psychology. That's like the number one rule. I remember a couple years ago with some of the SMB guys, that was like the epiphany I kind of had, is like, you want to push your risk, but so conservative so that if things don't work, it doesn't mess up your psychology. Because so many people would say, okay, I'm tired of being a wimp, I'm going to start pushing. A couple things wouldn't go right, or they'd take a big loss, and then it would ruin all their momentum. Then they would be too scared to grow at all, and so it would actually hurt them. So you really don't want to lose your feedback loop. So whatever that amount is going to be for you, that's generally what I would recommend if you're focusing on sizing. And the other part of that question is, when the market was really, really crazy, how did you do that with the sizing? And so I think that's where, if you have enough experience as a trader, you know when to break the rules, right? If you're 2-3 years in and you don't have a huge track record, or you don't have a lot of P&L cushion, you don't have the latitude to act the same way as somebody that's been trading 10 years, right? So in 2021, I had already been 10 years in. with a huge amount of P&L cushion and leeway and everything else. And when those good markets happen, like really good traders recognize that context and recognize that you need to be risking so much more. So one thing I would do is like even in 2020 and 2021, there would be some slow days. On those slow days, as part of my pre-market routine, I would be figuring out how much I want to risk each day. And so this surprises a lot of people, but for the majority of days, my initial lockout was $20,000. Very small. If there was nothing on the watch list, like my initial stop where I would just take that, whoa, I need to take a step back and reflect, 20K. That is nothing. But then there were days where I was totally comfortable risking hundreds and hundreds of thousands or $1 million or something. And even now, if I trade, I would say some of my risk is potentially, 6 figures or 7 figures. But it's knowing the context and having the experience behind it. So like, as a newer trader, you can't do that the same way an experienced person can. And if you're an experienced person, I would argue it's like essentially your job to make the most amount of hay while the sun's shining. Like the difference in career P&L, if you went absolutely nuts in 2020 and 2021 versus otherwise, is just mind-boggling. And I think like the beauty of working for a firm or working in a really good pod is you'll see the really good traders elevate their game way further than you ever thought. And when everyone else is competing and pushing, like I would imagine that because I was always talking to like, Shark and some other guys, and seeing the amount they were risking pushed me to risk more. Then me risking more, I'm sure pushed all the people in the office I was at to also risk more. And everybody really wins and elevates their game when everyone kind of steps it up. It's kind of like that thing about the 4-minute mile. Nobody was able to break the 4-minute mile. One person does it, then a couple years later, like 30 people have broken it. Why is that? Because like you break these mental barriers. And when the market is super hot, and even this year has been pretty damn good. It's obviously not a 2020 or 2021, but as far as being a non-panic crazy market, this is one of the better years. And you want people that in these years, they're going to really push and show you that path of growth, assuming you're at the level where that's what you need for your career. If you're a beginner, you just need to be making one good trade and working on execution and being in the right stocks. So yeah. Does anybody have any questions for now while I take a little pause? Or should I just keep going off this list? Feel free to interrupt. Anything for me right now? Okay. So the next thing that, this was actually Drew, thank you. So Drew had asked about my Micron short strangle. Can you show us on the chart what you saw as the asymmetric trade going into earnings? What cues did you use? What made you choose the strikes that you did? Did you let those expire worthless or did you close them earlier? Are you using a scanner looking for high IV options trades, or are you just looking at the underlying and seeing if the options give a more asymmetric opportunity? So what Drew is referencing is, so this was back in, I guess, late June, where some of the semis had cracked. And so for context, right, like this day, 6-20, in my opinion, this is likely to, and I actually even said this, I've said this publicly a couple times, like I was on the record saying that I think the probabilities that this day was a big picture high for the semis was pretty damn good. And so far, like I think that was pretty damn on target, like none of these have broken those highs. Like MU is absolutely wrecked. And so what happened though, for context, is all of these started to break down. And so Micron was one of the only semiconductor stocks that hadn't reported earnings yet. And so we cracked this technically. Micron was like right here, and it had earnings the next day on 6-27. And so what was so interesting is because of all these AI just blowout beats and everything, the IV going into those earnings was enormous. But I would argue, because this stock has run up so much, and this is just a pretty common thing, but like, look, this stock was just chilling, big move. We break out. This did not, this had no news. We went like 30% pretty much at 20% on just nothing. And so what happens when you get stocks that are just getting very bubbly and euphoric is the expectations baked into the stock price go higher, 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 right? Me putting this strangle on is way different than, like, I would never do this if Micron was still at 100 or 110 or 120 or even 130. The difference, though, is this pattern is now technically broken and the volatility was just still insanely, insanely high. I would need to go back and pull up the image of what price I sold them for. But I think I was able to sell like, I think I was able to sell like the 155s for like, I don't know, maybe like $7-8 and like the 160s for $5. All I know is my break even on the calls that I sold was something like 160. But then I also sold 130 puts that I think were also for like $5. And so when you did the math, because you captured both sides of the premium, like my effective short price would have been like 165 or like long at 120. That's like a really huge band all the way up here to all the way down there when we're at 142. That leaves a lot of cushion, and I was generally short biased given that this pattern had broken. And so then what happens? They come out with earnings, and the earnings were fine, but then everyone's like, oh, Micron fails to impress in lieu of recent stock up move. Well, it's like, yeah, that's exactly the point. Like this stuff gets priced in when it makes this. And so obviously doing stuff like this is kind of risky because anything can blow out, but I would just argue that you have a lot of cushion when the vol is so high and when the pattern's broken. Like this is a big psychological momentum shift. So if for whatever reason that like this would have opened 165, I would argue that the probability, or say it opens 170, I would argue that like the probability of that print getting sold and this kind of fading that day is pretty damn high too, when the rest of the sector is so wrecked. Am I using any scanners for this stuff? No, not really. I was just already watching all these semis. And so the one funny thing, this is actually how I really even actually, it's kind of embarrassing and shows I am sometimes an idiot. So when the semiconductors were making this up move on this 6-20, so Avago or Broadcom, whatever it is now, the vol, this had already had earnings. Like this was an earnings move, but the vol on this day was enormous. Like I was able to sell like the 190s for a huge chunk of cash. And so what I ended up doing was I also sold some of the Micron calls. And so then Micron just absolutely melted. And I'm like, oh my God, these calls are going to be down like 90%. I looked and like the calls were barely down at all. And I'm like, what the hell? Like, am I like, why are these calls still pricey? Like this must have earnings or something. And then it turned out that like, oh my God, Lance, you're an idiot. You sold calls that included the earnings release next week. So of course they're still going to retain all their implied volatility and everything. And so then I was like, wait a second, like these are still stupid expensive. And so like, I'm not using any scanners for that, but I'm definitely always looking at the options market nowadays for a lot of these moves. So it's just different ways of structuring this stuff. Yeah, did that make sense for you, Drew?
Yeah, I thought you were a little bit more scientific, but yeah, it sounds like I understand what you're saying. Yeah.
Yeah, it's yeah, no, nothing too scientific. A lot of that tends to just be like, oh my God, like how much cushion is being baked into this move? It's the same thing where it's like when GL had that short report and it's going down to like $45, like there can be a certain like at a certain price for anything, you have just so much cushion and risk priced in. And so this was one of those things where when the sector's cracked and the calls were still so insanely expensive, keep in mind, like Micron is a very large company and they're not really quite at the center of some of this AI crap. And like, to have a break even 15% above where it's trading, like that's a lot. Like most things are not going to have markets are pretty efficient. Every other semiconductor has now reported at that point. So So
Yeah,
yeah,
I think that's the nuance, right? Is that everyone already reported, you know how the sector's doing. The expectation is they shouldn't move much different than the sector has,
yeah, and
right?
yep, exactly. And so there is some certain, like, so many, like, there were some replies on Twitter where it's like, oh my God, that's just luck and like whatever. It's like, look, don't get me wrong, it is probabilistic. Like, I 100% could have lost on that trade, but I do think that, like, having seen these trade for a while, it's just markets get overexcited, you know, like there's still just psychology involved. And when stuff is moving this much, like, you know, vol gets really high. So yeah, and I would argue that, like, when you view these chart patterns as broken, that psychology does tend to matter. And there are times where it's like, you know, stuff then does follow my views more than randomness would imply, I guess. Let's see. So there was a question. Okay, so there was a question back on this IWM that I want to jump to real quick. Okay. And I think we're talking about this, correct me if I'm wrong, but I think we're talking about this 718. Let me jump to it. And the question was, how should we evaluate the kind of change of expected value in this IWM trade? For example, would you hypothetically increase or decrease size after the price goes back through the open? And so assuming we're talking about this 1-18. So for me at this point, when price goes back through the open, they call it this 221 area. Like, the way I'm structuring this trade, I guess it really depends how you're going to structure the trade. If I'm going to short here and risk to the prior day highs, that's not as appealing to me. If I'm going to give all the way to 226 or whatever, this isn't as appealing as what I could have gotten there. That being said, if this sets up, which I don't think it was so great of a setup, it's not enough consolidation. But if this really consolidated for a while at 221, like, let's say we just laid flat for like an hour, then we broke 221, I will absolutely do that as an intraday trade. And I think the expected value on that as an intraday trade is amazing. So I'd be adding size on that break, but I would not be adding size against the prior day highs. It's just a little bit far for me. And so that's why, like, a lot of this stuff matters your time frame, and it matters kind of your system of how you're trading it. So in general, there definitely could have the potential to be an add on that break of 221. In general, I think that's nice when you break those lows, but I definitely don't want to do it against those highs. Just, it's a little bit too much risk for me. So Spencer asked, ANF daily chart looked similar to ARM. How do you approach this trade if it gaps below the level, then comes back up and retests it? So let's see. So first, my question when I read this is, do I agree that ANF is similar to the ARM 120 and the VKTX dailies that we've dissected? Let's see. I don't know. Okay. And I think this came up somewhere and I kind of, you know, it's okay. So let's see. So this actually isn't that bad. So what we're really comparing it to is the ARM setup that was back here, where we kind of made this big move, lower high, lower high, lower high, lower high. Then we consolidate on 120 and break, or as we can compare it to this VKTX at 60, which kind of came all the way back on this gap. We set this level and we broke. So ANF, I see what he's talking about. Like, a lot of times people will say, hey, I think these dailies are similar. And I'm like, no way, Jose. But I definitely do think I can see this, right? Where this is a lower high, lower high, lower high. And we're kind of sitting on this 167-ish area. So then the question was, what happens when we gap down below? And I presume it's on the 7/17, July 17th, then start to push back against that level. And comes back and retests it. Are you risking less since it's showing some strength by coming back up to the level? And so my first question, and this is kind of similar to the IWM concept, is I'm wondering, how are we getting there? So what I want to do is I want to pull up this intraday and see, are we getting there super fast? Do we have an intraday setup? So let's see what it looks like. You know what we're gonna do? We're just gonna do it this way. Okay, was this it? No, I'm too far past. Okay, was this it? 16, 17, okay. Yeah, so this did end up pushing up. Like, I don't, intraday wise, like, I don't super love shorting this, like, as far as the intraday goes. Like, maybe I'd wait for this to turn. But then the other thought too is like, I'd almost wonder if like, maybe I'm potentially more eager to short down here. But I guess like the bigger premise is like, okay, given that this gapped below, then comes back up, am I willing to do, you know, like, because his point is valid in that he's saying, look, it gapped down, which is weak, but then, you know, am I willing to short that retest? And this is where it also comes down to selectivity. Like if this gaps down below, then kind of pushes back up towards that level, I don't know. I'm kind of conflicted. Like I don't know if I would necessarily bother unless we really formed a clear level on the intraday, which we didn't. If we had some really clear resistance at 167, I might be open to shorting that. But a lot of the times, if things don't just set up exactly how I want them to, I'll just totally pass on this. So I probably just would have done this as a total no trade. What I would have much preferred is this to kind of like open up kind of around the level, have intraday support at 167, then break. So a lot of the times I want like the intraday and the daily to just set up really well. Like in ARM and VKTX, there was kind of a nice intraday setup. Whereas this I don't love. So because the intraday didn't have some like nice clear resistance at 167, this would have been a no play. And a lot of times I'm just okay letting a lot of things pass by me. You know, I'd way rather be selective and kind of a sniper than trade stuff that's, you know, because it's I try to just stick to the stuff that's the really best traits with everything aligning. But that is a good question. So let me see, what else can I jump to? So another question was when should we trade the open and when should we wait? For example, especially for big cap stocks. Often I don't know how to establish when a certain price at the open is in no man's land and when not. And in addition of this concept, so often the stock already moves one full ATR in the direction of the trend at the open, and I feel late to the party to buy pre-market highs or pre-PhD break. I don't know what that necessarily stands for. Prior high of days break, maybe. Even if the stock has multiple RVOL, for example, crowd on 719. So let's see. Crowd on 719. Okay, let's see. So let's see. Yeah, so I mean, so first of all, like this stock has such a huge news catalyst that like in an average trading range is not even going to be remotely relevant on this day. You know, like in general, this is going to have a huge range just because of the news involved. So I'm not necessarily strictly following just like ATRs. The question then becomes like, you know, how do I know when we're in no man's land or not, and when is like the pre-market data and stuff relevant? And what I would say is like it really depends the volume. Like this stock is clearly trading not on like it's never going to be as the same volume as during market hours, but this is real volume and real trading. Like there's real liquidity going off. So like with this 310 or whatever, would I consider these highs valid? Like, yeah, I'm definitely paying attention to these highs. That being said, I don't think there's any good intraday here, right? We just, you know, we just drive off the open. And so as far as no man's land, like I would argue like, yeah, I would probably for this chart, I'd want to see a move above 310. But just as far as the intraday goes, like this like I never want to buy 310 after this intraday does this, right? You know, we started like 292. We've already moved almost a full 18 points. So in general, I'm just going to not be taking this trade at all. Like what I really would have needed to see or wanted to see is this kind of drive to 310, us consolidate and set up. then if we break out, I might want to take that because then we're breaking the no man's land and we're breaking into a new range. When do I trade the open versus not? Like I would say off the open, I tend to be looking more for mean reversion, or I needed to break if there's a real range pre-market, I needed to break that range. But this is one of those questions where it's more like experience than I can give some quick rule set as far as when to, trade off the open versus not. But like, again, for this, yeah, I do think this pre-market range is valid and I want to consider it, but no, this did not set up for anything I wanted. So another question, I really enjoyed reading your BPTH write-up. Gave me a few more nuances to consider for my own strategy. Can you talk about any of your old trades where you considered the highest number of nuances or considered some unique nuances to the best of your recollection? I think this will help us understand the depth of trade analysis an elite trader can do. So, I guess I probably need to think about this for a minute, but there's so many different nuances you kind of want to factor in. As far as some odd ones, I mean, I do a lot of M&A stuff. So there might be some stock that has, maybe a company's attracted takeover interest, and then you get someone saying, "Oh my God, the deal might come as soon as Monday." So there's times where I might want to parse the nuances of takeover interest and say like, "Oh my God, what do I think the odds are that this actually gets bought out? What would the premium be? What would the risk be?" There's nuances as far as, even if we take IWM, for example, I think IWM is a great example where I'm being aware of the very big picture, right? Like, okay, I need to be scared where if this really catches steam, we're going to have an all-time highs breakout that I definitely, if I'm selling calls, I don't want to get run over in an all-time highs breakout. But so I'm also factoring like the sector rotation, what the Qs are doing. I'm also factoring that this tiny bar here closed weak. I'm also factoring that this was one of the biggest bars during the day, despite it happening 3 days later. I'm factoring the amount of volume going off, I guess some other nuances. So, even like I was talking about in that GME kind of tweet rant I went on, I'm factoring stuff like with IWM, how, are we doing the same pattern again right off the open? Is it just an aggressive buyer? And stuff like GME, on this day here, how are people reacting to the ARCA buyer? As I posted in that video, people that pre-market were no longer scared at all of that ARCA buyer. And stuff like, you want to know a weird one? I got run over in this back in the day. Oh God, what was the ticker? I think wasn't it Viacom? Did this get, Do you guys remember like the disc A, like the Bill Huang? Why is this not popping up? Am I crazy on this? Am I crazy? Wasn't it just Viacom and the disc A? Why don't I have either of these charts? Does it just not go back historically? So long story short, with some of the Bill Huang stuff, some of the crazy nuances is when those stocks, I assume everybody knows about Bill Huang and Archegos, but long story short is this one hedge fund manager. What were the other stocks? Oh God, it was, hey Serge, do you remember some of the tickers, like some of the Chinese tickers that were getting wrecked too? If he's still here.
Like VIPs, remember was one of them.
Oh yeah, it was VIPs was one. There was something else 10-cent wise or whatever. Oh God, it's gonna kill me. But long story short, when Bill Huang blew up, which was in what, this was, yeah, I guess March of 22. And so what happened was Bill Huang had bought up all these positions and like in Viacom, and we're like, what the hell? Why is Viacom going up so much? Why is Discovery going up so much? Like these stocks are crazy. And these stocks would just rip. And like what it really turned out to be was Bill Wang was just like super, super over levered. Oh, thank you, Monish. CBS. Let's see. It's gonna help me. Oh God. I don't know if we're gonna get luck with some of this stuff. Okay, whatever. It's good enough. But long story short is during this saga, when these stocks were just getting absolutely pummeled, I did the really, really smart move of looking up who the major holders were on Bloomberg. So I wanted to know because like some of the block trades that were going off, like when you look up anybody that had that much size, you would look up on Bloomberg and you would see like, okay, how much, like I wanted to know how much size is left for whoever is getting liquidated. And what I quickly determined was like, based on the major holders on Bloomberg from the filings, there was nobody out there in the market that had this much size. Because if they did have this much size, they had to have had filed and everything. And so that's like when I was like, what the hell? This doesn't make any sense. And sure enough, what we later ended up learning was Bill Wang had very secretly levered up all of his prime brokers so that he ended up having like 10% plus of some of these stocks, but he wasn't filed as a major holder because a lot of it was due to options and derivatives. And so I had like, so my thinking was a really, really good idea. And if it wasn't for this like total manipulative, like very quasi-legal loophole, I would have been able to tell like when that seller was actually done. I mean, other analysis I'm doing, like even with the Chewy, with some of the options analysis, like you can see some of the flow go through these options. And so like when this happened on this day, like it was very similar to the options flow going through in GME. So that was pretty suspicious. So yeah, I think there's a lot of different nuances. I mean, I've done stuff even with closed-end funds. Like at some point, I want to talk about closed-end fund arbitrage, where I'm weighing the discount or the premium versus historical discounts and premiums. You know, so that's taking stuff like what is it, PHK or some of the PIMCO. So these PIMCO closed-end funds generally trade at a huge premium to NAV. Sometimes these can really implode, and I'll want to play that relationship. So there's a lot of nuances out there at the end of the day, from the box to the different interpretations of the news and everything else. But I won't bore everyone too much more with that. One question was, I've heard you speak on small caps and how you think Twitter is plagued with small cap shorters. Do these small caps not present the most edge consistently on a day-to-day basis? That these Twitter shorters are there because there is a high statistical significance to shorting these small caps. They just tend to have poor risk management and take huge losses. I would argue so many are able to stay profitable despite poor risk management because they have significant edge. They seem to be the most consistent broken slot machine day to day. Yada, yada, yada. So, and he makes a very fair point that a lot of the top public info traders are small cap traders. These are some interesting points. So like, let's take this bit by bit. Do I think small caps present the most edge consistently on a day-to-day basis? I think they present small amounts of edge on a consistent basis, but do I think in absolute terms the most edge? Absolutely not. Like I think some of the opportunities in IWM, especially as far as scalability, GME, AMC, I mean, the best trade of this year by a mile was still SMCI. So do I think these offer some of the best opportunities? Absolutely not. Do I think they offer some opportunities? Yes. Do I think there is consistent okay ones? Sure. But I think the reality is a lot of the people making money shorting these things, it's not that they have poor risk. The people making, let me rephrase this, the people making money consistently in these things, they're doing so because on average, these do of course retrace without a doubt. But nevertheless, like they're making money, but they're hiding their fat tail risk that every once a year like blows them up. And so, yes, there's some people on Kinfo, but like I would argue that some of the top public Kinfo traders are not. You know, like if we take Steven Dux, he is not like he does small caps, but like his biggest trades by a mile are not in the small caps, right? You know, he's crushing stuff like Bed Bath, and he's crushing patterns that like and stock opportunities that I'm trading anyways, as opposed to like, oh my God, he's making so much money on this small cap stuff. The other thing too, I would argue, is like a lot of these just don't have huge scalability and liquidity. And the other thing I would argue is like, I'm also curious profits after locates and commissions and fees on some of this stuff. The other thing I would also argue is like the last couple years have been very busy in small cap world. You can have years, and I'm not exaggerating, you can have literally years where the small cap space is just totally dead. So like, I think that data is definitely biased, and I think a lot of these traders are hiding tail risk. I would actually go, I know some, that being said, like, is there edge? Yes. I know a couple traders that are really good in the space. You know, they clear $1 million+ a year. That being said, do I know any trader that's ever done, you know, like 10 million+ in this space? No, not really. So I think for many people, just because most of these do tend to retrace, like, it's like, oh man, like this is such an easy, good strategy. I'm good at this. I have so much edge, but then you just take a whammy once in a while, which is fine. That's just part of the game. But I'd say like, yeah, I mean, there's definitely edge, but do I think it's the best? No. If somebody out there, and like, look, some days they do have amazing edge, but day to day, I would argue it's just mediocre, I guess. And in general, like there's again also just the scalability. Like I don't think any trader out there is making, you know, 10, 20, $50 million a year doing that stuff. But yeah, if you're small and nimble, like that can be an advantage. So yeah, I think it's a very valid space to play, but I just think if you're only trading the small caps and you're not touching SMCI, if you're not touching Nvidia, if you're not touching like IWM, if you're not touching stuff like Rivian when that is breaking news, or Tesla, yeah, there's nothing wrong with small cap space. It's more so that people are just so blind to there being anything else out there, and they're just blind to the tail risk they're taking on. So yeah, that's kind of more my rant. So the truth lies somewhere in the middle. Any questions for now? Does anyone want to interrupt me before I keep on blabbering?
Can you go through, since you have Tesla up, can you go through that? Or are you doing a top ops for this?
Yeah, that's kind of what I'm debating right now. It's
Okay.
definitely going to be in the top ops. One thing I'll touch on super quick, but I kind of will just save this one for the top ops because I think it kind of looks like a cop out when I just say like, oh, I just did a long video on half these things. One thing that was interesting, like I'll touch on all this, but I guess two things is like one, you know, look how well this held prior bar lows when I think a lot of people were kind of fading this early. There was actually one really cool op on, I think it was 7-3. Let me see. There's a couple points I'll make. I don't want to like belabor this. Seven dash 3. Yeah. So this was, we were talking about multiple legs before. And so this made one leg off the open. We make a nice consolidation. I think you need to get out if you're short. Because keep in mind, this is overextended on the daily. But the way I look at this is like, we did like one leg, we did two legs, we kind of do mini like third leg, which kind of pulls back, then like mini fourth leg. You know, so I'd almost call this like 1, 2, 2.53 in some ways, you know, and even if we look at the distance covered on some of these, you know, it went roughly 5 points, it went roughly 5 points, and then we went not quite 5 points, but we already were losing steam. And so I just want to make the point that like after these multiple legs, you know, I do think I was shorting this. And so it's like, I got some size, you know, here, not that crazy, you know, covered. I got more size here, not that crazy, but once it really, you know, kept going, that's where I got really aggressive. But again, I'm not going to dig too deep into this. The other point I want to make, just because I have it up, is the same example with that IWM crack and some of this other stuff. What I thought was a really interesting trade was, so this cracked really hard that day, right? And this is kind of, you know, like huge volume crack, big run up and everything. Then we kind of retrace some of that gap. So this was the day where on 7/15, this was the day after that Trump assassination, and a lot of stocks like DJT were trading up on that. And Elon had endorsed Trump over the weekend. And so this, first of all, in like overnight trading, this was trading at like 262 to like 264. Like that in overnight seemed like a short to me, just because it seemed like for such a big company, what Elon endorsed Trump, like this isn't DJT. This is one of the biggest companies out there. I thought this was an interesting short, expecting us to not break these highs again. That's my general theory, right? It's like once we get the big capitulation or the big turn or the big crack, generally those highs tend to stand more often than not. So I shorted some overnight, not a ton, because I'm trying to avoid this stuff. But then like we open up down here, then we end up running intraday up there. And it's like, look, you can structure this so you short. I think, let me pull up the intraday. I think this was pretty sharp again, if I'm not mistaken. Again, and that intraday, like the speed and the aggressiveness that it does this stuff, it's always so important. I'm always jumping to these intradays for a reason. Yeah, so nothing that crazy. We did sit up here some, but like we're weak off the open, we pop, we pop. So nothing that crazy, but I do think there's an argument that can be made to short this against the highs. Not that the intraday was amazing. Anywho, that ends up holding. But yeah, I think that's all I want to touch on for now, because I'll just cover it more in depth. One sec, I think we got more things in the chat. So one question was wondering how much of the magnitude Tesla flushed was attributed to the setup quality versus the versus tech just washing. And like, we'll never know that answer. I mean, I'd argue it's all of it. And one thing that I'm going to do in my top ops is rant, like so many people in retail world didn't even know about the Robotaxi headline. Like that's really what cracked the stock. Like it was cracking technically, and you got a technical break combined with a huge headline, which was actually what really, had sent the stock up a fair amount. I think this gap here was when the Robotaxi thing was announced, like, so it moved it a good couple percent. So then when you get the technical break with that headline, with tech cracking on CPI and a catalyst, that's everything aligning. Like I would argue that this crack was maybe one of the best opportunities of the month so far. So one question from Jacques, do you enjoy being famous? I would argue I am not famous. And one thing I would also argue is if I am even remotely famous, it is in a very small, boring world of day trading. And I would also say my demographic of, like 18 to 30-year-old males is probably not, the target demographic that you want to be famous with. So take that what you will. So I overall, like not particularly. Like I think the best part about some of this stuff is I've met some really great traders. It's nice that I've been able to help a lot of people and everything, but it also comes with just a lot of time loss and everything else. I mostly do it just to give back and model some of that stuff. But yeah, overall, not my favorite thing. I mean, stuff like the Wired was really cool. Like doing that Wired interview was fun. So it's a mixing of good and bad, but I don't really like being like Googleable. I don't really like having P&L numbers and stuff out there. So there's a lot I don't like, but I've just come to accept knowing the trade-off that, hey, you can potentially help, thousands of people be better and model good things and kind of have a larger voice. Actually, one thing, here's actually a side benefit of being, bullshit Twitter famous. And this has happened a couple of times now. Sometimes I've had customer service issues where like you just can't get a hold of anyone. And then if you start bitching on Twitter, or if you DM the customer service or the Twitter account, I do think that if you have a decent following and you're verified and stuff, I do think there's been a couple times where I've got customer service that I otherwise wouldn't have gotten. So for example, I've had an issue getting into my healthcare account where like one of my emails was deactivated, so I just can't get the verification code. Anytime I call customer support, like they just give me like, the loop around for like, literally for months, I've been unable to access this account and their outsourced customer service is useless. I've DM'd the company and literally like I got like a VIP customer service person calling me within 1 day and fixing everything. So that is the benefit of being famous. The biggest downside I would say by far is just like, I don't like P&L and stuff being in the public spotlight. Especially, it was kind of like tough. Like I do want to hate on all the Furus and everything, and that required me to, especially making this course, required me to verify myself, and I think it was important just ethically and transparently. But I've got a lot of just friends out there in normal world that don't know of any, like most of my friends in normal world don't know anything of Lance the Trader. I'm just normal Lance that does a trading job. So the biggest downside was probably, yeah, I just don't want myself out on the internet. Yeah, so overall net negative. Okay, anywho. Serve had news of NVIDIA taking 10% stake in the company with stock float of 23 million shares. Can you dissect the Serve trade from Friday, exact entry and exits as we were opening? Also, would you go long on the break? I don't think I've taken a look at this thing. Was this recent? Yeah, I guess this was recent. I totally missed this one. So the Serve trade from Friday. I might skip this for now while I just read more up onto it. Yeah, I'm just going to skip this Serve trade and get back maybe in one of the other top ops, just because I didn't see this move yet. If an easy money trade is this slow, replicable, high probability trade, what are the common characteristics of those swing hard, big size, home run top ops? It seems like there's some distinctive differences between these, but it's not entirely clear for me. So that's an interesting question. So often I talk about the easy money trades. And so an easy money trade is generally something that you can kind of prepare for. Like maybe it's this ARM daily breakdown back here. And so the question is, how does that differ from the big home run trades? So I'd say the big home run trades are really, really fast moving, but huge reward. It's generally in the stuff that like the stock's really moving around a ton. It inevitably involves a fair amount of risk to some degree, but you can really just scale it and really go big. So big home run trades like this SMCI, you're talking about, you're trading a $1,100 stock where the spread alone is probably like 5 points most of that day, and it's moving like 200 points, 300 points. So that is a play for big boys. You don't really want to be trading something like that on like your first month, your first 6 months. It's moving very fast and things can really get away from you. And so I think some of the home run trades are the stuff that just have a lot of potential to make big bucks. If you're shorting some of these semis for size, that's potentially a big trade. But of course, sometimes you can kind of have both. There's times where like an easy money trade can also just be very scalable. But I guess like all of these things are kind of just made up in my head anyway. So I wouldn't say there needs to be any set definition, but the big differentiators about how I think about it is the home run trades, or when you size really big, like anything in GME, like shorting GME on some of these days when the stock is having halts, when the stock is gapping up, when there's really big moves, this is not for the beginner novice trader. Any of this stuff is not for the beginner novice trader. I consider these kind of like the harder, faster home run trades. Whereas stuff like just basic daily setups, basic intraday setups, bouncy ball setups, those tend to be slower and more newbie friendly. So other question, how do you build your size scorecard and what logical processes do you use for determining optimal capital allocation? The gist of this answer is going to be like, there isn't any right answer I can give because it really depends what someone's comfortable with. There's going to be people that are okay losing 20% of their account, 50% of their account. There's going to be people that are not even okay with the 5% drawdown. So for me, a lot of it was like, you need to reflect the market. So if things are going crazy and we're in 2020 or 2021, I'm willing to risk way, way more because in general, I'm getting way better hands. I'm getting pocket pairs, I'm getting face cards, I'm getting pocket aces. So in really good markets, I'm in general willing to risk way more. So the context of the market matters. And then I would also say, just the person's individual tolerance matters. You know, like someone that is 22 with 100K in their account is going to be able to have way different risk than someone that is 52 with 4 kids and 10K in their account. You know, if you can re-up your account and it doesn't matter, that's way, way different. So I try to stay away from giving any specific details on some of that stuff because it's just not going to help versus confuse. Yada, yada, yada. So one question that I think I'm going to touch super briefly is can you add some of your thoughts on LPLA on 718 and 719? And it's funny this get asked because I know people are seeing this daily chart and they're like, oh my God, this chart, this is such a big move. I guarantee you that most of the traders looking at this, they're not aware that there's news on this ticker. Essentially, there is a huge class action lawsuit that came out and could really just hurt the fundamentals of this business and kind of the spread they make on some of their assets. So this essentially is a move on news. I'm sure most of retail world has no idea that this is on news, but it is. So I don't really have any interest in fading this whatsoever. That doesn't mean I won't play this. Like maybe this does capitulate. But in general, I don't want to touch this until there's a break of prior bar highs or a true capitulation. The other thing to keep in mind is this ticker is pretty damn liquid overall. So given it as news, I'm just not so eager to step in front of this. Let's see. Boy, you guys sure had a lot of questions today, which is good. What would you recommend? This is from Guri. What would you recommend to a trader who always struggles adapting to the market? I personally scalp options on big mega caps that sometimes markets just get choppy and volatility drops. It usually happens after a pretty hot market, and out of this, all of a sudden, the change in market regime takes away part of my P&L. I mean, I think a lot of that is just like, how do you anticipate when the market regime is changing? And I think a lot of that is once you've been trading long enough, you start to anticipate and be proactive rather than reactive, right? Most volatility and big ops like don't really last long. So in general, anytime there's a good period, I start to think defensive. Like even already going into July, despite it having ops, I've told some of the people at SMB, like, okay, guys, you know, be wary if things slow down. I do think minus some of the good ops, like day-to-day things have been much slower. And so I think it's up to you on figuring out how can you define when the market is slowing. If you thrive on there being high volatility and stuff, maybe you only trade if the VIX of something is a certain level, right? So maybe you need VIX above a certain amount. Maybe you need you know, the implied vol on the Qs to be above a certain amount. So I would be asking myself, how can I make a rule set that kind of leads me to bet more when things are active and really turn it off when things are not? You know, so maybe what that means is anytime that the VIX is under 10 or something, I'm being very defensive. And I know VXX is a poor example. You generally probably want to use, oh God, you know, the actual vol index, but you know, I'm not going to get too much into that, but ultimately, like you want to find a set of rules that help you bet more when the odds are most in your favor. And then just as importantly, really, really turn it off. So what would you suggest to a trader who trades one style very well and has a hard time holding trades no matter what he does, since he should he focus more on sizing his scalps or spending more time on ability to hold? I mean, like there's for so many of these questions, it's not going to be that binary, right? Like, and that's what makes back to the original question that we were talking about before I started recording with like edge erosion. There's so many questions that nobody can necessarily answer for you, and the individual needs to do the hard analysis. You know, how much should a person risk in each trade? How much more should someone bet on an A opportunity than a B? With exponential betting, just how exponential should you be? Nobody can answer that because those are specific. And like, should someone focus more on sizing scalps or more on ability to hold? I can't speak to which will have the bigger impact on your trading. Nobody can speak to that but you. So you should be running the analysis. Like, how much money can I make in my scalps? Is the only thing holding me back just like In general, if there's liquidity in your best trades and you can size those up, that tends to be the lowest hanging fruit. But if there's not liquidity and doing more size is going to hurt your expected value, then that might actually hurt your trading, in which you should work on ability to hold. But as for someone that has a hard time holding trades no matter what you do, my question would be why? Why are you getting out of the trade? Do you have a set rule? Are you breaking your rules? Is it just the P&L moving? If it's the P&L moving, can we start to trade these things for 1 share? Can we trade these things for 10 shares? Can we trade it so that the P&L doesn't matter? You know, a lot of these things just don't have answers without knowing the specific person and what is going on. So I've gotten to the point where I can predict the direction of gold pretty frequently. However, it has been difficult to find an entry method that captures my idea consistently while at the same time being able to provide a decent risk reward. So I would say, you know, hate to break this to you, but that's what makes trading so hard, because it's not just about where is something going to go. It's about building a system to capture it. And I think a lot of times something can be somewhat predictable, but the whole system of being able to capture that and protecting your downside and actually having edge, that's the real hard part. So like I would argue that like there's a lot of times you can kind of find something that looks good, but if you can't build a system, you still don't have edge. And that's a lot of the things that are true for the market. So like like I would argue that in trader world, if you have the right idea, but you don't have a way to capture it, it's worthless. And like the amount of times I've had some trader or someone come up to me and be like, hey man, I've got this amazing strategy. You know, it just doesn't have a system of how to do it, but like I can do X, Y, and Z. And it's like, well, guess what? You know, that is actually worthless. Not worthless, but like until you're able to build the other side of it, it just doesn't help, because there's a lot of ideas that you can't do that. So what I would really be trying to do is just figure out, like, a lot of times you need to find specific nuances that can push the odds in your favor. Like maybe it's saying, I'm okay. Hey, I might know where gold ends up, but the only way I can capture it is when it makes this very specific pattern. And that's where kind of the rubber hits the road, right? Like, it's one thing to say, oh, I think IWM is going to go lower, but then you need the system of like, okay, what I needed to do is to be the backside. We need to break prior bar lows, but then if we push up, I can have an entry on the intraday that allows me edge in the long run. So that's what makes trading so hard. But it's ultimately trying to find those setups that allow you to capture the idea. An idea is almost, you know, less than half the battle, and it's the way easier part. Okay. Any
you
questions
might-
for now?
Yeah, I was gonna ask actually, because that was my question. So I just wanted to like kind of follow up on that a little bit.
Yeah.
So would you actually say that like it's like a fairly common scenario that like you'll kind of know where where stock's gonna kind of end up by the end of the day, or some certain level is gonna get taken, but there's just no way to really capture that per your system or whatever?
Well, so here's my question is, do you know, so you say 80% of days. So here's the thing though. The question is, when you're right, what is your reward when you're right? Like when you're right 80% of those days, how much does it go in that direction? And when you're wrong, how much are you wrong by? Because in theory, couldn't you just risk some small amount each day and just kind of have a very crude system of just saying, okay, I'm going to bet, you know, $10 we go up today, $10 we go up, and just keep scaling that up?
That's kind of where I was starting to get to, because basically what ends up happening is I kind of create like a morning video every morning or whatever, and kind of outline, okay, I think gold's gonna get to this point, and I think it's probably gonna rally up to here, and then it's gonna get to this point or whatever, right? And so what I end up doing is like, okay, I'm gonna wait for it to rally up to here, then I'm gonna wait for it to break a level on the intraday or something like that, and then enter to go towards my target. But waiting for that, a lot of times I'll miss trades because it will break the level and then just never retest, or it'll break the level, then wick around for a bit and I'll get shaken out, stuff like that. So I'm kind of like at this point where I've gotten so frustrated where I'm like, maybe I just hit the trade and like have an overall like higher time frame invalidation point and then just short
Yeah, I
it, kind
mean,
of like with your IWM thing.
I mean, in theory, if that data is right, I would just simply say forget the nuance. Like in theory, if I just bet $10 or whatever amount, right? If I just bet X, how does this perform over time? Like forget, like, like in theory, you could just say, okay, I'm gonna take the open price on day one and the close price. And like if you have the open price and the close price, and if 80% of the time you're right and there's edge over time, I don't need any setup. Like I might just potentially say I'm going to buy at point A and sell at point B. So there's a lot of like quantitative or algorithmic models like that do just very crude analysis like that. And could it be more optimized? Sure, but maybe that's just not your bag. Like there's firms out there in quant world. Like I've worked with friends and worked with some of these places where it's like their whole bet is they're not doing 2-minute bar highs or any of these trailing stops. They're just saying 75% of the time, point B is going to be higher than point A. The expected value on it is this. We've got the capital cushion where as long as we size this properly, over time we will make money. And that's fine, so there's nothing wrong with that. And so I'd say like, if you can refine it, great. But if not, like there's nothing wrong with a very crude system. In some markets, I would do this thing where, and this was a while ago now, but like we had data that like, markets would actually gap up like the first day of the month due to just like pension fund inflows. So essentially like any time that especially if the market was really oversold or really panicking into the close on the last day of the month, we would just buy X amount of exposure and I would just take the opening print on the first day of the month, and like you would argue, oh my God, there's no stop. Well, one, I'm just buying an index, and two, I'm sizing it so that even if something wacky happens, the S&P is not going to be down 50%. And if it is, we're all, probably fucked anyways. And so there's different ways to do that. So sadly though, like those are things you need to test just because ultimately trading is very hard. And that's part of what makes it hard is you can have the idea, oh my God, IWM is going to retrace. But here's the thing is if I short IWM here or IWM here or IWM here, I might still just get totally blown out, even though my idea, oh my God, IWM did end up retracing. Or if I'm just like power fading this day, I can get blown out and then it just goes all the way back. So much is in the devil's in the details in this game.
Gotcha.
Yep. Let's see. So this was another question about No Man's Land, which I kind of touched on already. So this is a question where the stock has news and the price is in between pre-market range after the open and gives opening range break. So a lot of these questions are just going to be too simplistic. Like you can't just simplify this stuff where it's like, oh, when is the opening range relevant? When is the pre-market relevant? Like I really kind of need to know like what's the volume going on, how big's the stock, everything. And so there are examples given here. So match with initiation on 7/16. So let's see, 7/16. Seven. Okay. Yeah, so this is an example where like this pre-market data, it's like nothing. We're doing like 100 shares, 1,000 shares. At least once this opens, we're doing hundreds of thousands. So I don't really view this pre-market range is that relevant in this specific case. Gapping up and faded half the opening range break. And so like pretty much I would say the way I look at this is like, off the open, this ends up being the range. Like the range ends up being 33, I don't know, call it 3370 by 3890 or something, roughly. So this I consider the range. Anything in between here I generally view for the most part as like, I don't want to be, you know, buying or shorting in here or anything. Like this is just the middle of the range. This is like the total equilibrium middle point of that range. You know, where would I theoretically consider, like if you put a gun to my head, I don't necessarily like any of this, but if I had to buy anything, I'd probably be buying right here. And then just leaving alone all this other stuff. So then JD on 7-Eleven. JD on 7-Eleven. Okay. Yeah, so I mean, capping up, opening range break. So yeah, I mean, all this pre-market is like nothing. You know, we're doing just hundreds of shares again, especially once we open, we're doing hundreds of thousands per bar. And so then as far as the opening range, like I kind of consider like the opening range is 2740. We make this leg. So here I don't want to necessarily be buying anything in here. Like this, you know, maybe I want to consider, but then once we pull back, you know, the range goes from 2740 to like 2830. Then the range expands to 28, almost 50. So if I had to play anywhere, as far as along, if I had to play anywhere, you know, I don't love this stuff, but if I had to pick a long anywhere, I'm buying here or I'm buying there because that's where the range is breaking. And here we finally at least, you know, start to consolidate nice. So would I personally play any of this stuff? No. But at least that's where we're outside of the ranges. And the pre-market on this stuff, I don't view as relevant for any of that. So Michael C, what was your why for trading? Did it change over time? Yeah, I mean, I think everybody's why changes over time. I mean, for me initially, like trading was just kind of the coolest job out there where it was just kind of playing a video game. It's fast paced. It's a casual work atmosphere. I think all of those things made it appealing. You have freedom, you have autonomy. It's not a job where you need to wear a suit and with a lot of ass kissing. It was kind of just very entrepreneurial and meritocratic, where if you perform, you get paid based on that and you can do really, really well very early. So I thought it was just a job I might excel at. I thought it was a job I was going to have fun at. I always enjoyed playing video games. And while now competitive gaming kind of exists, like there was no competitive gaming back then. And this, I'd argue, is kind of the closest to it. And I think over time, it went from I want to make a living at this job to then, of course, you want to make as much money as you can. But then it also became, I just want to be one of the best at the firm. You know, eventually you start competing for the top 10 and then to be number one. Then eventually it was like, okay, I want to make money to just potentially give back and ideally make the world a better place. So yeah, I think everyone's why always evolves and our values evolved, right? Like, especially as I started to value health more and more, trading in many ways is not so great for health. Just between the stress, the poor sleep, all the other stuff, being sedentary. So yeah, our values are always changing. And, you know, today I try to find a healthy balance of being healthy, still making the big, easier money while trading, and then trying to give back in various ways while, you know, having fun in the process. Would you mind sharing some of your monthly reviews here on Patreon, blah, blah, blah. So a lot of my monthly reviews, I'll look to see if I have these. I don't remember what format I took some of these down, but I'll take a look. And if I have them in some easily digestible way, I will try to post them. So Jacques asked a question about Tesla. I'm going to skip Tesla just because I'm going to cover that on the top ops. Man, there were a lot of questions this time, which is good. So Mark asks, you mentioned that breaking news trades. Oh, real quick. So from the chat, wondering how do you feel like AI might change trading? Honestly, I'd say this falls into the question of I don't even bother thinking or thinking about this stuff. Like I don't spend 1 ounce of time kind of just trying to hypothesize on this. It's like when people ask, oh, what do you want to be doing in 10 years? Like I view that as just totally meaningless because like inevitably over the next 10 years, my values are going to change. And like, life and everything is just so uncertain. So for me to even kid myself and think I know what I'll be or what I'll value or what I'll be interested in 10 years, it's like there's no chance. I'll be a different person in 3 years or 5 years. So how do I feel AI might change trading? I don't know. I mean, I think in general, like trading always gets more efficient over time. And it's just a question of can you adapt faster than the market adapts, right? Like in theory, day trading and just being a discretionary trader shouldn't exist. People said in the late 90s, day trading's dead. Then people said in like when I was taking the job as a day trader, everyone was laughing at me. They're like, oh my God, do people still do that? Like that stuff's dead. Fast forward 10 years later, another 10 years, like we're still, I mean, 15 years actually, like people are still just asking the same question. And who knows? I don't have any insight that I think will be valuable other than make hay while the sun is shining, and rather than focus on questions without a good answer, just focus on what you can control and doing your best for however long. So Mark asked, would you share how you identified and trading breaking news so effectively? I seem to always be late after identifying a breaking news event. Analyzing the stock, then pulling the trigger. Also, what news service do you think is adequate besides a Bloomberg? Is Benzinga fast enough? So Benzinga is absolutely not fast enough. Benzinga is kind of like a secondary service that is more squawk, right? So Benzinga will never be fast enough. The same way that Trade the News will never really be fast enough, because all of those are squawk services that are just kind of aggregating the news, like a Hammerstone or whatever else. I mean, Bloomberg is, of course, number one. If as far as the best bang for your buck, NewsEdge or Newswatch, where you can just scrape, I mean, they just have direct APIs plugged into some of these press release sources. So yeah, I think like doing like a NewsEdge or Newswatch is good. Bloomberg, of course, is the best. As far as how to identify and trade these, I mean, step one is of course having the right news sources. If you're using a squawk service, you're always going to be behind. There's no way about it. And then a lot of it is just like with anything else, right? It's like driving a car. When you're 16 trying to drive a car, your processing speed on this stuff is just so much slower because you don't have reps now, right? And take a 16-year-old versus, say, a famous F1 racer or a NASCAR racer. You have somebody with 0 hours of processing experience. Then you have somebody with 20,000 hours of processing experience where their whole job is to study all these nuances and react as fast as they can. That leads this huge gap that seems superhuman. So a lot of it just comes from reps, and reps. Like first, at least having the right news sources, having the right filters, and then just through endless databasing and retrading these opportunities, you eventually get a feel for what are going to be the big headlines. And then I would always, just play the game of like, anytime you see some big headline, what are the repercussions? What's the trade? What's the trade? What's the trade? This is July 21st. The big news today is Biden resigned as president. What's the trade? Okay, it's a Sunday afternoon in Eastern time when that happened. What market is open? Bitcoin's open 24/7. Guess what? That if Biden resigns, that means Trump's chances are probably marginally worse. That probably means Bitcoin down. That means probably DJT down. That might mean Tesla down. So I'm always playing the game in my head as far as like what's the trade. When Trump got shot, what was that, last week? Yeah, I think it was last week. Crazy times we live in, eh? When Trump gets shot, Trump dies. What's the trade? What is the best ROI on your buying power if Trump died that day and markets were open? If that happened on a Tuesday afternoon, what's the biggest trade? Okay, Trump got his Trump got his ear nicked. What is the best trade for that? Are we thinking long DJT? Are we thinking long Bitcoin? Are we thinking long crypto? And so we want to kind of play that game with ourselves as far as like always thinking, what's the trade? What's the trade? What's the trade? If Trump tweets, okay, once I'm president again, it's time to make China pay, we're bringing back the trade war. What's the trade? Short FXI, and like then there's triple levered FXI and stuff, yada, yada, yada. You could even potentially be long VIX. So it's just training yourself to always think about these things. And then of course you want to start testing it on 1 share, 100 shares, whatever, and you just build reps. Another question, I learned the concept of exponential bet sizing from you and I'm trying to implement in my trading. I want to know the magnitude of risk change between your A plus, A and B plus setups. I know you worked in prop and risk allotment is different, but let's say you have a 100K account and then can you tell me how much you would risk? So again, it's really hard to do. I really kind of hate these questions just because like what's going to be right for me is not going to be right for someone else. And it's also based on so many assumptions that no one ever mentions. Like if I have a 100K account, how much will I risk for these setups? Well, guess what? If I lose my 100K account, am I totally bankrupt? Will I ever be able to refund? Is that the end of my trading career? Does that mean that my family goes starving? All those things are going to really depend on how I trade that. Like if I'm never able to refund my account and this 100K is all I have, then like, you're welcome, Drew. Drew just said, thanks for the AMA. Very welcome. Thank you for the great questions and attendance every time, Drew. It's always good having you. So how much would I risk in these? Like there isn't really any great way. So again, it's with like a zillion disclaimers when I say that, like, if I had a 100K account on some of the best setups, I mean, yeah, I don't know. I think there's almost no setup, I don't think, where I'd be willing to risk 50K. Like that, to risk 50% of your account seems pretty crazy. Is there a setup where I'd be willing to risk 20K? Yeah, probably. There's probably some A plus, like an SMCI this year. Like I don't think it's that crazy to have risked 20K if I have a 100K account. But again, if I can't ever refill that account, maybe that's only 5K or 10K. So yeah, it's really just doing what's right for you. And I know you even said, I understand these risk allotments are personal, but I'm going to, as always, just try to really defer on these because it's just such a complex decision. Then the other thing too is like my A or A plus or B might not be like the same as someone else's. Like I might think, an A plus trade is something that comes off a couple times a year. Somebody might define A plus as a trade that happens, once a day. So there's just a lot of complexities. So one question from Terry. Terry asked, what's your preferred setup? The setup that you will take every time it presents itself? That's a good question. I think some of the absolute best trades in the market are when you have a headline that just you're faster and I'm more on top of it than anyone else. Like I think having overnight access, way back when Roaring Kitty was starting those tweets, like that was some amazing opportunities. I think some of these, like one thing I would say in general is I think some of the euphoric panics to the downside are some of the best opportunities. So if SMCI was panicking, like if this was like some stock doing the inverse of that, where we went from 1200 down to 300 with this big exhaustion gap, because with a long setup, if this panicked to 300 and I was able to make, potentially 100% of my money or like 200%, like really big epic long flush outs definitely have some of the best returns out there. So let me see, like take even, MST, I'm not going to be able to go back in time so well. But when this panicked down, this stock went from like 400 to about 150. I've written this up before in a matter of like a couple weeks. So that was an amazing setup because again, like it's just holding Bitcoin. This has some lower bound and everything. So some of those long setups can be amazing. I also think sometimes you get setups, not quite FFIE, but you'll get some of these setups where you can get long a stock that's beaten down and risk potentially pennies. And it's just so asymmetric. Like this did epic volume. And, this closed at 26 cents. And this isn't a great example, but there's some of these setups where this might have gone up like 10 cents and you risk a couple pennies. But if these go, not that anyone expected this to happen, but you can just make huge asymmetric amounts. So there's a couple out there that are just really good. Then I think the last question, at least off the Patreon list, so many times I wait for the tape signal, then entry. I do really well in exponential sizing now, but so many times if I use tape for entry, it's so easily for me to be affected by the tape, which means I always exit early by the tape. What do you suggest me do, or what was your thinking after having a position so that you can manage it well? So one thing is like, in general, I might use the tape for a very specific entry, but often I'm not using the tape to get out of a stock. Like I think using the tape, you can be very, very precise and get a good feel for sentiment, but I'm not using that. I'm still referring to the chart for my outs. So even with like GME, when we had that ARCA buyer, like the ARCA buyer, let me go to this after hours. So this was 6-6. Boy, I'm also starting to lose my voice because this is a huge amount of talking. Okay. 6-6. 2 minutes. Okay. So as I had tweeted, an ARCA buyer was really driving this move up. So this is something where like an ARCA buyer allowed me to kind of time an entry very precisely towards the highs, but then I'm not like using the box to get out so much as then I'm using just prior bar highs and my normal system. And I'm relying on the chart. So my short answer is like the box and the tape helps me be a little bit more nuanced, but then I'm just using the chart for a lot of those holds. And that will just help you hold a little bit better. You don't want to just be so myopic that you're just obsessed with every little nuance of the box, then you ignore the big picture. You know, a lot of the trades I'm taking are very big picture driven, like IWM, for example. So I think I hit every question on here except the ones I intentionally wanted to delay. It's been roughly 2 hours, but any final questions from you all? Is there anything that didn't make sense? I know I talked pretty damn fast to get through all this. Anything I can readdress or answer that I did not cover?
I just had like one more quick question, if
Hit
that's
me.
all right.
Yep.
Yeah, I just wanted to get a better understanding for like how you trade, and it seems like some people, other people might be a little bit more familiar. Is there like resources on the Patreon where I can look to see kind of some of your stuff, or is it all going to be kind of covered more in depth in the Magnum Opus?
I mean, I would say the most effective use of time to get the gist is like those top ops videos, which I think I even have like tagged in one place. Like to watch a top ops video, most of these videos we're talking 20 minutes. And I think I probably have like a year of videos by now. That's probably like the greatest return on your time. I can't imagine all of them take more than a couple hours. And you can, of course, watch them on 2x even and slow down when you want. But that will show you specifically the exact stocks I'm trading, the exact ways I'm trading them, and the exact why. So I do think that's like the kind of greatest bang for your buck is just figuring out like what are those easy money trades for Lance? Why was he in those? And as you start to go through them, you see that like a lot of the stuff isn't like some stuff is complicated in rocket science and like super nuanced, but a lot of it is just like, oh my God, really big headline and the same system works again and again. Or like, oh my God, you know, like for anyone that's been doing this Patreon for like a year, like the amount of stock offerings where it's like, oh my God, stock offering, then it just holds prior bar highs and like steadily gets weak, or like, oh, M&A headline and it just steadily holds prior bar lows. Like some of that's just very replicable at this point. And so I think that kind of gives you the biggest return for your time, honestly. Then there are some decent concept videos, but I would say once I get Magnum Opus ready, like that's just going to be like the true like course itinerary where you can just go video, like concept to concept, and it just covers everything. So yeah, if trying to be efficient, the top ops for sure.
Appreciate it.
Appreciate you joining the cult, as they will. Any other questions from anyone else? All right. Well, going once, going twice, 3 times sold. Thank you all for another awesome session. There were so many questions, so many good ones. And I just love doing these and hope they help. And let me know if anything else comes up.
All right. Thanks, Lance.